Investors have poured so much money into treasuries that their yields are among the lowest in 2 centuries. Our next guest has some concerns about this kind of mentality that's playing out in investing in the bonds market. Michael Jones is Chairman and Chief Investment Officer of Riverfront Investment Group. He joins us from Richmond, Virginia. Before we get to that thesis, Mike, I want to ask you quickly about this headline we saw. Continental shareholders voting to approve merger with United. Still waiting on United here to vote on it. But would you be interested in getting into the airline sector in the wake of this?
Well, yeah, these mergers are helping take capacity out. They're helping to improve the pricing power of existing airlines. But I had a professor at Wharton who said something I've never forgotten. If you want to design an industry that's going to lose you money, give it high operating costs, load it down with a lot of debt, and then make its business really, really cyclical. And that's a perfect description of the airline business. And over time, I don't think any industry has lost shareholders more money than that one.
So a consolidated industry, not any more attractive to you on either front there. Well, let's move to what you're talking about here. You think essentially that investors have the wrong sense of safety. Treasuries, if you're investing for income, are not the way to go right now.
Yeah, if you look at the 220-year history of the U.S. Treasury market since Alexander Hamilton created it, we've only traded at these kinds of interest rates twice in the past. That was during the Industrial Revolution and the Great Depression. And those were periods of time that were marked with pretty sustained deflation in the U.S. economy. So your low nominal returns were somewhat offset by the fact that the price of everything else was dropping. So that says to us, if you're going to validate current interest rates, we're going to have deflation. And we think that's a pretty low probability outcome when you've got Ben Bernanke, the world's #1 expert on deflation and how to avoid it, as your Federal Reserve Chairman.
So what do? Do you chase yield to dividend-paying stocks? I mean, how do you find safety?
We think that right now, if you look across all kinds of fantastic companies like Abbott Labs, like McDonald's, they are paying more in their stocks and their dividends than they're paying on their 10-year corporate bonds. And unlike the corporate bonds, those dividends have a history of growing even during the incredibly stressful economic times of the last couple of years. So you look at stocks, you've got downside risk. You look at bonds, you have downside risk. If interest rates go back to just where they were in April, a 10-year bond loses 10%. But at least in the stocks, you've got the potential for that income to grow, and you might even get some capital appreciation at some point along the road.
Would you advise getting into ETFs, or you're still in sort of a stock picking mode?
You know what? There's some great ETFs that also play this theme, like PFM, that are high quality, dividend-oriented stocks that are not necessarily trying to maximize your current dividend yield, but are trying to maximize the growth of that dividend over time. So we find good success in some of the ETF strategies, but there's also, it is a stock picker's market when it comes to finding high-quality companies, great dividends, and the capacity to grow those dividends.
All right. Thanks for joining us, Mike. Have a great weekend.